Welcome back to Make a Mill, the channel where we all want to make it 7 figures. So let's get started on that journey right now. Today, I'd like to talk to you about options analysis, analyzing these options contracts. In a video a couple weeks ago, I did a trade where I opened this put contract, and I'll link to that if you haven't seen it. But I went through all the mechanics of how you would place a trade. In my broker, I showed you what all these variables mean and how to place the trade and kind of how much money you're risking. Now here I want to show you how to kind of analyze that in a more like a managerial accounting setup. So I have this little financial model set up. So I thought we'll just do some math and some numbers. It'll be fun and groovy, and I'll show you how the numbers work. So this is the contract. I've preloaded it with what I had, and I'll explain every number to you. So we had quantity 50. We wrote 50 contracts. And the premium we got was about $773, so a little under $800. So what I'm going to do is I'm going to standardize this down to one contract. So it's a little easier to think about one contract than 50. So I'm going to divide the premium, and you'll notice the ROIs won't change. Watch. They'll be 258 and 865. And I'll explain those in a sec. But first, just notice that these are the same. Now, the gain loss is different because we have one contract, but the return per contract is the same. It's a standard. So it's easier to think about one contract just for the sake of this video. The strike price, that tells us the price at which we'll have to buy these shares. If the price is below this, we'll have to buy it. That's the way put contracts work. If the price is above our strike price as a seller, the contract would expire worthless because nobody would execute that because nobody's going to put shares in your hand that's worth more, right? So, but they're only going to execute if it's below this $6. So then this amount, this is an output. So all the yellows are inputs and all the blues are outputs. What I actually risked was 50 contracts at 773, right? And so I'm actually risking 30K. If we bring it down to one contract is only risking, 30K divided by 50, which is $600, right? We're risking $600 on this contract, and that's how much we'll have to pay to buy 100 shares. That's one contract is 100 shares. That's how it works. So we'll have to buy 100 shares for $6 a share, $600, right? Open date, that's the date that I opened the contract. That was a few days ago. And close date, you select that. That's the expiration. That's one of the key variables that I showed you last time. How do you choose it in your broker? And it's one of the main things in options trading. You have different chains for different dates, and I showed you how the chains work and how to look at the probability for each contract last time. So I chose December 20. Now this is an output, just like this calculated the amount of capital. There's two inputs to this formula where we're going. You can maybe see where we're going. We had a capital side, and now we have a kind of a time side. So this is just simply those two dates. This date minus this date, and that's 112 days. Another input is the amount of premium you get. That's the revenue, basically. We call it premium because, as I told you last time, this is a business of insurance. So it's a language of insurance. I receive a premium to insure your stock. That's what I receive. That's my revenue as an insurance kind of company provider. So that premium, and that number is going to fluctuate. The price of the option is something that's determined by what the Black-Scholes model and other models can describe it too. But basically, the price of an option in the market is like the price of a stock. So that contract price changes day to day, or even hour to hour, or minute to minute sometimes. That's what I closed at. Okay, I closed at $15.50 a contract. I'm probably down on it now, I think. I'll pull it up later, but I'll explain these first. So then I just symbol, right? And then whether it's a put or a call, I just have these because you'll see it's a cool little, if you didn't notice it already, it changes it. It's pretty cool. So that is the amount side, the capital side. This is the time side, and now we're going to put them together. We needed these kind of two. This is how we make the sausage, right? We need these two like intermediary steps. And this is not. I don't do this calculation on a day-to-day basis. I'll show you the shorthand afterward. I just wanted to show you like where this comes from, and so that it kind of demystifies how to analyze these option contracts. And what this lets you do is standardize contracts. It lets you compare a contract within a company, like maybe within a different strike or a different expiration within the same symbol, Warner Brothers Discovery, or across companies. You can compare Warner Brothers December 20 with Disney December 20 at a similar whatever strike. If you can standardize contracts, you can compare them. If you can compare them, you can find price inefficiencies. If you can find those, you can make money, and you can make more money. Basically, the way options work are you sell to open. You'll see here it says sell to open, and then you can buy to close. I'll demo that later, and I'll explain that later. It's in orange for that reason. So we have about a $15 gain if the contract were to expire. Let me take you through that scenario. That's at December 20, at the close of the market day. Actually, it's the Saturday. Technically, it's the Saturday into it. It can close after the trade, but let's just keep it on the 20th. If the price goes below 6, it's very likely that the person on the other side will execute to get their profit. And I think it's almost automatic in most cases. You will get those shares, and you'll immediately have an unrealized gain loss. That's if it's below. But if it finishes at 6 or above, and it's really at 6 minus the premium, but let's just keep it at 6 or above, the person's not going to execute, and that contract will expire worthless. Just like when you renew your home insurance every year and it doesn't burn down, you keep paying it. The contract expires worthless. And that is what's so great about selling options, because 80-90% of the options expire worthless if you do it right. So let's continue on. So if this is assuming a scenario where the cost to close is 0, and that all that means is that the price of the stock was above $6. That means we guessed right. We said, hey, I'm going to insure this for $6. I don't think it's going to go below that. And it didn't within that time frame. So you get the money. And so that shows you the max return. That's the maximum return on this contract is $15, okay? That is an absolute return of 2.5% roughly. And the way I'm getting that, you can see the formula here, but the way that comes about is you're basically just taking the premium, your revenue, and just dividing it by your risk, the capital you risk. Pretty simple, right? You put in 600 and you got 615.47 back. That's if the contract had expired worth it. The way it works is you get the $15 up front, which is cool, because then you could invest that $15 over 3 months and earn a return on that, which I do. So that's great. So you get the cash flow up front. That's one of the huge advantages and benefits of this kind of strategy, that you get the cash flow in your hand the day you write the contract. You do take the risk, but here we can assess. I showed you how to assess the risk last time and kind of mitigate it. And let's talk more about the return, though. So we have the ROIs. This is the absolute ROI. So this divided by this. Now, what we want to do, we can't just calculate the ROI, and it's not very useful to compare ROIs across contracts. We want to standardize those ROIs. We want to annualize them. So that's all this formula does, and I'll just show you it's just the compound annual growth rate formula. And I'll show you the shorthand to do this, so you don't have to do all these steps every time. If you stick with me till later in the video, I'll show you the shortcuts. This is the formula. So we have the annualized return on investment. We have a return factor here based on what I just showed you. That this is basically, it takes this ROI, it takes this 2.5%. That's what this first factor calculates, adds it to 1.0258, right? And then it takes an exponent, it exponentiates it, and you see this 365. That gives you a clue that this is the time factor, right? We're talking about a year, so we're annualizing it. You can standardize them down to a month or to 3 years, but 1 year is a pretty good way to standardize it, I found. And then this is just simply the number of days. And then you subtract 1 just to make it a percentage, and it returns about 8.5%. And which is about right, because if you took 2.5% and you kind of annualize it, I said this is roughly 3 months. So if you multiplied it by about, let's say 3.3 1/3, because you have some compounding, a little more, you're about at 8.5%. It makes sense. If you analyze 2.5%, every 3 months I make 2.5% on money. Over a course of a year, I'll make about 8.5%. That's all right. That's pretty good. So I decided, for my purposes, I was okay with this contract based on the risk, based on the return, and a number of other factors. It's just nice to know, hey, the probability that it would get assigned and that I would have to buy these shares is, I think it was 1 in 6 or 1 in 5. I forgot what the probability, but the probability. And the return is 8.6%. So now I can kind of calculate risk return, and I can kind of compare contracts across securities, across strike prices across expiration dates within the same security. So you see how this is very useful, very, very useful. And it's a simple formula. Let's run some scenarios now. These things can change. And in the real world, most of the time, contracts don't hit expiration, right? You want to be buying to close these when they go above 50, 60, 70%. And what that means is the way that you kind of win at the options game is it's like a little bit of reverse logic. You get the money first, and then the whole game is you're waiting and you're trying to close the contract and you're trying to pay back a little bit less money than what you got. So I'll just run that scenario. Let's say we had it at 50%. So let's say 750 or whatever, close, right? So if our rule was, hey, every time these contracts reach 50% profitability, that means I only have to pay back about half the money to close a contract. It will change the AROI, the annualized return. And I never look at the standard. I just did this for illustration purposes. I never look at the straight ROI. I always look at the annualized return. So you see, if I paid half the contract back, the return cuts in half about, right? Makes sense. But what if I closed it early? Because notice, like when it was 0, I waited till expiration. That's at the 20th. But I'm not going to, at the 20th, pay $750 to close it. That's going to be happening. Let's say that happened a month before expiration. I saw that the price of the stock changed, and the price of the stock is one of the key variables in the Black-Scholes model that affects the price of an option and affects this kind of trade. So when the price of the stock changed some way, I saw that my position was profitable, about 50%. I decided to close it by buying it back with about half of what the premium I was paid. Okay. What's the return? It's about 6%, right? As you saw. What if I close it another month early? So this is scenario analysis. This is a fun little tool. Oh, now it's a 10% return. So it's like, okay, if I write the option here and I hold it a month and a half, it went from an 8% return, 8.5%, to a 10% return. And I only collected half the money. Right? That's just the way the numbers work, the way they crunch out. And it's just so great to have this kind of scenario analysis so you can run it in your day-to-day, right? So what if the price was less to close it? If it was, these are the positive scenarios. I'll show you the negatives in a minute. If you only had to pay a third of the price, back, so you had a kind of a 2/3 gain here, you had $10 on 15. This is like 13% annualized. That's an incredible return. And that's the kind of thing I try to do. And I'm doing it every day. And I do it as a portfolio. I do it with this company, that company, that company. Instead of buying shares, do this. And you collect the cash up front. You can redeploy it in bonds or whatever and collect an extra interest or premium on that. And it's all gravy, baby. So let's take this a little further and to the scenario analysis. And what if it's most likely you'll write the option and you'll immediately be in the negative. That's the way it works. You're in the red at first, right when you write the contract because of the bid-ask spread, which I talked about last time. You're usually kind of illiquid with options. So you're usually immediately when you write the contract, you see a little red right there. So like if you had to close the contract back, you would lose 5%. Like let's say that you wrote this and then you decided halfway through the contract, 6 weeks in or whatever, I didn't like this company. I changed my mind. You can close it down, right? And it's nice to know what you're losing at the same time. The loss can technically go to infinity, but you don't ever have to pay that back. So, for example, when you open your contract, it's a liability. So it has a fixed maximum value in this put. It's $15. That's the maximum return. The loss is technically infinite, just like the loss of a stock is technically infinite. So that's why it simulates the position. You don't really have to worry about that because the worst case scenario, if you don't want to pay the money back and you would want to collect the shares, is you just receive the shares and it's an unrealized gain and you hold them. If the company then goes out of business, yes, you lose all your capital. But that's the same risk you take buying any shares. So don't tell me options investing is riskier than buying and selling stocks. I think it's actually less risky because you're able to kind of buffer yourself from owning the shares, and by doing that, you're able to take that capital that's buffered and redeploy it in a high interest savings account, for example, which is what I do, and earn extra interest on it, on the capital that you're trading. So that was a lot. That was a word salad. Let's move to the next part of the video. I told you about some of these shorthand calculations. The way I do this is you have a return factor. So I just showed you the way I think of it. I look at one contract, no matter how many I'm writing, just because it's easier. And then I just add the premium to the capital. So it's easy to know what the capital per contract is. The strike is 6, so it's 600. And then you just add the premium to it, 615 divided by, I wouldn't even put the 0.47 here, because in the real world, I'm trying to do speed. I wish brokers would include this AROI calc alongside the actual price so you could avoid all these calcs, but I haven't found a broker that does that. Let me know in the comments if you know one. I'm actively trying to learn Python so I can do that and build a platform that does that. So if you are a software person or engineer, let me know, collaborate with me, because I'd love to build something that does this in real time on an options chain. This is the time factor now. I told you that earlier, so that didn't change. Just to prove it, it's the same return. Now, just some tips, just to speed things up. Like I said a second ago, these calcs are not included on options chains usually, which sucks. But the way that I found to speed it up, you can Google days till whatever your day, November 15, and Google will spit it back real quick. It will tell you 70, 75, 62. You don't have to sit there and do it in Excel or do it on your phone or whatever. Count the day. I was counting the days at first. You can use the search bar to do the calculations in the browser. I can't spell them. In the browser, you can do the calcs faster. And you don't even have to pull out your phone. That step takes some time. Do it right. Search the days in Google and then immediately preload it with this little formula and search the days or whatever. And just, that's what I do. Use software. I was talking about that, Python or AI or apps to automate some of these calculations is nice. And just wanted to show you, last thing before we go, an equivalent return factor that if you just do the math out, this is actually the same as 1 plus the premium divided by the capital risked. And just to prove that to you, there it is. And it's also 8.65%. So I hope that this helped understanding how we analyze option contracts. Stick with the channel. Subscribe if you love this kind of content. I really appreciate it. We're trying to grow this channel. Any kind of engagement you can do helps. If you have any questions, I know it was a lot. I went fast. Don't be scared. Don't feel shy to ask questions. Don't feel embarrassed. We try to answer every single question, and we love this. We do this stuff every day. We do this finance stuff every day. We're trying to help everyone else profit and benefit off it. So until next time.